Here are 3 reasons why to subscribe to Fringe Financials on YouTube. Number 1, it is free, which is the best price that you can pay for this kind of content. 2, I am completely transparent with all of my investments. And number 3, I have a variety of educational videos every single week. Now let's get on with the video. What is up, YouTube, and welcome back to another Fringe Financials video. I know this is not my normal uploading day. Usually I look at Monday, possibly Wednesday and Friday. But last night we had open house and I was at school until 9 o'clock last night. Such is the job of a teacher. But in today's video, we're going to be recapping some of the major events that happened over the last week. And there's even a major event happening between today and tomorrow, as you saw in the last video. So if you're excited for today's video, make sure you smash the thumbs up button, subscribe to the channel if you have not already done so, and turn on the bell notifications so you do not miss out on any future videos. So, ever since the last video that I made that came out with talking about the important news coming in this week and next week, we are now fast forwarding, and as you will see here, we're going to be talking about a couple major things that came into play. So the CPI data came in last week, the PPI data came in last week, the UAW is on strike, and we'll look at that as well, and we also have the Fed meeting that starts today, and we'll be finishing up tomorrow. And what does that mean for the economy? Well, first thing, this headline from last week, inflation accelerated in August as oil prices surged. So oil prices are going absolutely insane right now. The prices have been increasing just nonstop over the last couple months in the energy field. And as you will see here by looking at the consumer price index, it rose 0.6% over the last month and 3.7% over the prior year. So it is an acceleration from July. So July was 0.2% monthly increase. This one's up 0.6, so a 0.4% difference there. And again, an increase in about 0.5% over the annual. Now, this year-over-year increase is in fact slightly higher than the economics forecast of 3.6%. So it's a 0.1% difference year-over-year. And like I said in my last video, depending on if there's going to be a huge beat, as in it comes in better than expectations, or about expectations, depending on what the market's going to do. The good thing that I can conclude with this is, from last week especially, is that there wasn't like a huge increase in inflation prices and everything else. There wasn't a huge increase in consumer spending. If this number came in at, say, like 4% or whatever could possibly, or even higher or something like that, then do a little bit more concerning by saying that, you know, it was predicted 3.6, it hit like 4 point something. It's a huge difference, not a good thing to look at for our economy. But predicting 3.6, getting 3.7, again, isn't the end of the world here. Now, again, a rising price of energy definitely increased this CPI data much more than I thought. So it's at oil right now is at just below $89 a barrel, which again is a lot higher, and highest oil levels since November of last year. Now, last week I was talking about how a core data works, and the core takes out those volatile, markets like food and gas, as it says here, energy as well. And you can see that it is a little bit of a slowdown, which is great compared to July. So it's coming in at a beat of about 0.4%, which again is a great thing to see. And the monthly core prices rose very, very slightly. So it was a mixed day in the market for this as a result of looking at the inflation values. So right now, as we're looking at things, it's looking like it's kind of going to be still what the Fed is expecting. Maybe, again, it's a little bit of a miss on some aspects, a little bit of a beat in other aspects. So from this data here, the markets didn't have a crazy impact. They didn't go up or down like 5% or 3% or whatever. I'm pretty sure if I remember correctly, it was like a sideways day as a result of this information, which is, pretty okay. Again, coming in at expectations is no big deal. Now, looking at the next page, which is talking about the UAW. So last week I made a video about the automakers possibly going on strike, and I was like, oh, what's better, a used car or a new car? Well, this strike that went into effect as of last Thursday night, technically Friday morning at 12:01 a.m., this strike definitely is going to have a huge change to your car prices. So what's really interesting about this, and I can show you some of the information here, is what they're really doing with their strategy is they're dividing and conquering, where they're not putting everybody on strike all at once. They're only having a portion of the 147,000 members striking at select plants. That way they can maximize how much money they have in a union fund. So usually they have a union fund. If you are part of a union, there's teachers unions, there's auto unions, there's steelworker unions, there's all these different unions that go around to make sure that there's, fair rules, fair regulations, and everything else for the employees. And so they have a reserve fund that they put money into in case something like this does in fact happen. So what the UAW is doing here is that they're only going to be doing a portion of 147,000 members to be striking at plants. And that way it allows them to kind of spread out and maximize their value. Because again, what happens is that they have to pay their striking workers $500 a week to cover the costs and expenses. So they have to make sure that they cover all of those as a result, which is why they're spreading it out instead of trying to use all $825 million up at once. Now, in looking at this strike here as a result from last week, like I said, what would happen to used car prices here? Not only is there going to be a big hit in the automaker aspect towards the GDP, which again is going to be hit in only 10 days. It's going to be a huge $5.6 billion hit to the GDP here. It's also going to be impacting car prices as a result. So going all the way down to this article here. So again, in general, the strikes overall put even more pressure on new and used car prices, which have remained near record highs in large part to the strength of the consumer and ongoing supply issues. So essentially, again, they're striking at these plants. They're not creating new cars. They're not creating used cars. And just like I said last week in my previous video, you have supply and demand. When there's demand for vehicles, but there's not a lot of supply, they have to increase the prices to counteract that lack of supply they have. And this strike right here is going to definitely impact that supply chain issues they're going to have here. So looking at how that's going to be said, you're going to see an uptick in car prices over the next couple weeks, next couple months, until this strike is resolved and people are back to work. But right now, there's not a lot of cars being made. There's not as much inventory as you would expect. And as a result, you're going to be seeing a little bit more of an increase in car prices over the next couple weeks. So if you're looking at buying a car, just be careful and take a look at the sticker prices because they might be a little bit higher than you might expect. Now, instead of talking about the CPI data and also talking about the strike, which are huge things, again, coming into play, I talked about last week, but also the PPI data, which is your producer price index report. And this number came in, let me show you where the values are, which is right down here. So the August PPI rose 0.7% month over month, faster than 0.4% of an increase as gas prices spiked. Again, having that energy and gas just really hit these PPI values and the CPI ones. The core PPI here, again, excludes volatile foods and energy prices. Energy prices, again, takes out that oil because oil prices are through the roof right now. So there actually wasn't much of a change over month, which is great. There was no change at all. So again, coming in at about what they were expecting. But again, it rose at a quicker annual pace of 3% compared to July's 2.9%. So which means that, again, the producers are paying a little bit more for their supplies, which means there might be a little bit more of an increase in the materials and the products they produce for the consumers, but coming in at 3% compared to 2.9 as an expectation in July, not a huge difference, which again is kind of what we're hoping for. And what's also a really key thing to note, which we was talking about as of last week, none of these data points really move much to the expectations. And this was as of Thursday morning this came out. The markets are already pricing in a 97% chance of them keeping interest rates unchanged at next week's meeting. So next week's meeting is tomorrow about the interest rates. They started the meetings today and they started talking about where the economy is going and everything else. And as of this moment in time, as we look at the Fed projections and the expectations, they are right now pricing in a 99% chance that they're going to hold the rate steady. So what does that mean tomorrow? There's big news tomorrow still, but if by some chance they hike the rates and it doesn't go as well as everyone expects, you're going to see probably a huge crash in the market and a little bit of a freak out for it. So tomorrow they'll be announcing rate hikes if possibility. I don't think there is. It looks like it's already being priced in, which is fantastic. So we'll see kind of where the economy goes from here. That is it for today's video. Again, just kind of recapping the news over the last week. So again, CPI data came in a little bit higher, but nothing too crazy. The UAW is on strike, which means there's probably going to be an increase in car prices, both new and used. So be on the lookout for that. And again, PPI data came in at a little bit of a mix as well, which shows again that it's kind of where they're expecting it. Maybe just a little bit of faster than they're expecting to. But it's right now priced in at 99% chance that the Fed will not raise rates tomorrow. So watch the news tomorrow. Read on the rate hikes. I believe 2:30. Either 2 or 2:30, if I'm not mistaken, where they're going to announce the interest rate hikes. So watch the news for that one. I'll be updating you guys again as well after that meeting with another video. So hopefully you guys enjoyed today's video. If you have any questions, feel free to send them down in the comment section. Hope you have a great rest of your day, and I will see you later.